The Ukraine-Russia conflict and the world's response is affecting markets. Inflation remains higher and rising. The Fed raised and plans to raise rates further. The yield curve is trying to tell us something about the economy. Gambling risks are far higher than investing. And we'll talk about what the stink eye effect is on some people's portfolio. We'll cover that and more today in Quarterly Context. Welcome to the first quarter of 2022 Quarterly Context for clients and friends of the advisor group. I'm Greg Patterson, CEO. For those of you not familiar with the advisory group, we are a wealth and life strategy firm focusing on helping business owners and leaders with their financial goals in their personal and family realm, their fiduciary, employee support efforts, and their communities through their foundations and endowments. To complement the strategic goal work we do with clients and planning, our Quarterly Context webinars are designed to make economic and other information approachable and usable. High-level perspective regarding the economy, markets, investor behavior patterns, and other elements to help clients stay more relaxed and make better decisions towards your goals by being well informed. The first section is mostly higher level and concepts. The second section has a few additional details and charts. And we try to keep the first section to about 15 to 20 minutes. We'll also circulate a video link afterwards should you like to view some part of it again or to pass it on to someone you think we can help like we've helped you. As a reminder, always, we encourage people to think about the key section between things that matter and things that you can control. Recent volatility is a good reminder of that. We can't control markets. Investors cannot control markets. You can focus on your goals and the decisions you make around being a non-emotional investor and keeping tight with your long-term goals and plans and current actions that are consistent with that. As always, there is news that moves markets. This has been a more news-laden quarter than usual, at least in the last number of years, I would say. Interest rates rose for the first time in a while, and a rise in interest rates is expected in the future, and that's also made markets a little bit nervous. However, markets in some cases actually responded positively to rate rises because they viewed that as a bigger risk to manage than or view inflation as a bigger risk to manage than the impact that rates might have on directly slowing the economy. They talk about no longer needing such aggressive stimulus, and really the idea of trying to dampen the economy a little bit through higher rates to control inflation so that inflation doesn't overheat too much for too long. Jobs continued to improve. Inflation did reach about 8% year over year in February, the highest rate in about 40 years. The oil prices really shot up, especially given the Ukraine-Russia dynamics and the impacts on of both sanctions and supply chain questions. Those are some of the key things. We'll talk a little more about some of those. So the rates that went up, I'll have a kind of just a summary detailed chart here, and then we'll get to more concepts and diagrams, but this can be a helpful reference for those that kind of want some of the key metrics all in one place. Fed raised rates up into the 0.25 to 0.5 range, and it's expected that a number of hikes, additional hikes will happen in 2022. The Fed expects 6, the market expects more than that. And just today, actually, in the middle of April, the Fed seemed to clarify that there will be a 0.5 point rate increase in May. And it's been quite a while since there's been anything other than a 0.25% incremental change, either up or down. So the market will pay attention to that. Unemployment was down to 3.6. Some good news in terms of overall jobs. Of the 22 million jobs that were lost related to the pandemic, 90% of those have been regained, so that's good progress. Despite that, and despite income being up for the average person, there are more people living paycheck to paycheck, in part because the stimulus programs have been weaned back and people overall income may have less of the temporary boost that was from those stimulus programs. China's growth after being flat has picked up a little bit, but may then be dampened by a significant resurgence of COVID and a heavy restriction regime there that has implications for supply chains and could complicate inflation a little bit. We talked about the inflation number. The biggest driver of that was energy, up 26%, so it's really a major contributor, and energy can be volatile in both directions, especially when there were even just concerns about supply. That's caused a real boost, and of course you can all see that at the gas pumps. However, gas prices were also elevated a few years back, cooled off, and so if you're looking at the medium-term high versus the near-term low, energy hasn't gone up quite as much as it seems, although it certainly is at a higher level. At some level, as we've mentioned before, we're just surprised that inflation hasn't happened sooner, given the heavy stimulus that's normally associated or normally followed by a more inflationary period. All of that, those concerns led to a pullback in the markets, a correction of about 20% at its worst point, and then worked its way back up to having about a 10% drop in total. That will be variable. We'll see where that goes. And that led the quarter to be negative to about 5% for the US stock market. However, energy was up 40%. So those stocks are doing quite well in this kind of environment. Value beat growth, and the US yield curve, the bond yield curve, flattened and then ended inverted at the end of the quarter, and an inverted curve usually precedes some sort of recession, not always, but is sometimes a predictor of a weaker economy in the future. Given the rate dynamics, the rises and the expected rises in rates, the bonds in the US had its worst quarter since 1980 at almost 6% negative. Global bonds, or international bonds, were negative 4%. And one of the managers we typically use that had been having weak returns added some nice diversification with only a 0.9% return within the bond portion of portfolios. In terms of COVID, we can see the big uptick has cooled off some. However, it's picking up in some areas as the latest variants have spread, and there's some indication in wastewater management monitoring tools that there is some new upticks that could be on the horizon. But overall, people seem to be getting a little more back to normal, and that's strong for the economy, but to the extent that people over-relax before another potential spike, it could exacerbate that spike. Wage growth, as mentioned, had picked up a little bit as unemployment has come down. That is good for the overall economic stability, except that that combination can also complicate inflation, which is viewed as a negative impact on the economy. So there are competing factors there. Inflation, as you can see here, the trend up to where it stands now at an elevated level. Consumer sentiment, given the dynamics, all of the dynamics we talked about so far, is at its lowest point it's been in a while. A little bit higher than the pandemic low, but pretty much spot on with that level. So people are generally concerned relative to near history in the last 10 years or so. Inflation, or rather rates, remain very low, but that it's difficult to see on this chart that there's an actual slight uptick here, but rates are so low that just going up 0.25% doesn't really show itself on the chart. But again, after a multi-decade period of rate reductions, after a high inflationary period in the 70s and early 80s, the Fed
instituted rate hikes as a method to control inflation that was very effective. The gradual reduction in rates over time has led to a long-term boost for bonds. Now that we're in the lower rate environment, potentially and likely going into, or will be going into a rising rate environment, the question is for how long. That will naturally, as we've talked about for the last couple of years, that this would eventually happen, lead to some volatility in bonds over the medium term. However, as rates go higher, new higher yielding bonds come onto the market, get incorporated into portfolios, and can actually lead to higher return portfolios. So there is a benefit to rising rates. It's just at the cost of some short-term volatility in bonds, and that's something people are not used to seeing, but it is not abnormal. Here we can see the equity market returns, sort of a competition to see who could have the bigger red number for the quarter, with emerging market stocks doing the weakest, really heavily driven by Eastern European numbers, given the Ukraine-Russia conflict that really sort of pulled down that segment and led to a negative return for the year as well. Positive returns elsewhere in stocks for the year, but negative essentially all in the 4 to 6% range or so. Not too surprising given all of the dynamics that are happening. Interestingly, the magnitude of bonds drops at the same time, so there's high correlation across all asset classes for the most part, given those dynamics and the rising rate expectations and actual rising rates that led to negative returns there. And that has, of course, those returns have pulled down the one-year return into the negative territory for the moment. If we take a look at the 4 worst markets and where the current global financial crisis and COVID dip market combined lands us, that puts us right about the end of this blue line, which is a bit of a normalization of returns, actually getting a little closer to the projected long-term returns. And it's still, despite the recent volatility, and this is important for people to remember, even with this recent volatility, even if it dropped 10 or 20% more, we would still be above the long-term average. Not that we're suggesting that that will happen, but it's important to measure things against the long term and not just against what might have been an inflated short-term high water mark. If we look back over the last 10 years, again, despite this recent volatility, still long-term returns, 10-year returns in the 10 to 17% range. So that's very high relative to very long-term returns, especially in the upper range in the 14, 13, 17%, whereas very long-term returns are in the 9 to 10% return range for overall stock markets. Year to date, you can see negative returns across the board. Value performed the least bad at a little bit less than 1%, whereas growth had a much more difficult time across all market capitalization or company sizes. Since the market peak in February of 2020, still very strong returns since then, and since the market low, of course, even stronger if we're looking at the COVID bottom. So that may help people feel a little bit more comfortable with these recent returns. Some of this is just correction, bringing things a little bit closer to earth, and still ahead of the game if we look at 10-year averages for sure. Mentioned the yield curve earlier. The end of quarter 331 yield curve has a partial inversion, as you can see here. That means that there are some medium-term or longer-term bonds that have yields that are lower than short-term bonds. That is traditionally a message that the bond market is saying that there's higher confidence about or about certain sections of the bond market, that implies a concern about the overall economy in the medium term or the short run, and sometimes, oftentimes, is a predictor of some level of recession. Not always, but sometimes. So that's given everything that's going on, inflation, war, and other dynamics, not entirely surprising that the bond market would show a yield curve like this. One thing we find interesting and a little bit entertaining to talk about, since some people talk about investing as if it were gambling. These statistics here show, and we call this the 401k corner because we will use this type of information when we're doing 401k education for 401k clients and their plan participants and employees. But the same type of information is generally interesting to most people in that if you have a whether it's yourself or a friend or family member who just doesn't feel comfortable with investing because they feel like it's the same thing as gambling, they are right about gambling, at least, in that gambling by definition has a lower than 50% chance of having a positive return. So, and essentially that means a greater than 50% chance of losing everything. Whereas with stocks, the longer you hold, the less chance you have of having any kind of negative return. But when there is a negative return, it may only be a small or medium-sized negative return. There is never 100% loss in the history of the stock market. So the farther you go out in time, the much lower the chance of any kind of even small negative return, and that can be soothing when markets are volatile like they are now, to remember that just being patient improves your returns. From an investor behavior standpoint, there's an interesting dynamic that studies have shown that just looking at your statements or looking at your balance online can damage your own results. Now, the reason that it works, there's something called myopic loss aversion, where when people look at something too frequently when they're concerned, if there are weak numbers, which is generally when some people tend to look more often if they're concerned, and they see that their returns or market values are down, that can lead to a brain response, a fight or flight response, more on the flight side, that might cause someone to push for or change their stock bond mix to have more bonds and less stocks, and systematically in the long run, that leads to lower returns. So we've sometimes referred to that as the stink eye effect. Ironically, just looking can make it worse. Since we're on the topic also generally of a weaker than normal bond market in the last quarter, this chart shows the frequency of negative returns of bonds over full years going back about 40 years. So you can see that while there may be some quarters along the way that are negative, it's unlikely statistically to have a negative return in bonds for a full year. It may be that there's a negative return this year in bonds. That's hard to predict. But if it is, it's generally relatively small and oftentimes followed by stronger returns, as you can see here, sometimes materially stronger returns. So patience and discipline is important in unusual environments where bonds are negative as well. And again, remember that the long-term past returns have been relatively strong for bonds and for stocks, so some of what's happening now is just bringing down the average from a much higher than normal average to a little bit less higher than average. In terms of the rules and regs and reminders corner, a few things have come out on the fiduciary side, not a lot on personal wealth or general specifics to share. On the fiduciary or retirement plan side, there's a new Secure Act that may be helpful for some plans, a new law proposed for the creation of starter, what are called starter 401k plans. It would be streamlined for very small companies. It would have certain limits, lower overall contribution limits and so forth. So not attractive for most companies, but it's designed to be a simplified, more streamlined way for much smaller companies to help their employees and the average American save more, since a lot of very small businesses or micro businesses have no retirement plan at all. We also have a number of new blog posts listed here that has to do with inflation, some of the myths of early retirement, some surprising data there that people will find interesting. periodic table, which we've referred to in the last quarterly context as well, charitable giving, and other elements that you may find helpful and interesting reading, and things that you might also want to share with others that you know might be struggling with or considering some of these topics or encountering them. So before we get to the second section, I want to thank you for your thoughts always. We always want feedback that helps us improve both this presentation and what we do. So if you are a client, please always feel encouraged to reach out to me or to anyone else at our firm and share your thoughts. If you can think of one thing that would materially improve your experience in terms of how you're interacting with us or what we do for you, we would definitely like to hear that. And we also want to thank those of you that have passed our name on to other organizations in the hopes that we will be able to support them like we've supported you in terms of improving financial fitness, overall peace of mind, and long-term strategic goals and planning. We'll jump quickly into the second section. Just a snapshot here of what the typical business cycles are. So at the moment, we're probably hovering somewhere, even though it'd be hard to call us what we had before this a strong expansion, but sort of a moderate continued expansion, maybe given what the yield curve is projecting, maybe in late expansion now. It'll be interesting to see where that goes. Stock market valuations still remain, in a number of cases, elevated relative to history, but the last quarter has brought some of those back down into more normal levels. So this is another interesting way to keep in mind that it's normal to have a little bit lower valuations in general. And as we've mentioned before, when there are elevated valuation levels, it's usually followed by some weaker returns. So we're experiencing some of those weaker returns now, but to the extent that market valuations are now lower and may go a little bit lower or to some degree lower, that is oftentimes followed by higher 5-year returns. So that provides some encouragement in the long run after this bout of volatility straightens itself out. You can see the large cap growth US companies, a lot of the big tech mega cap companies fall into that category and still have the most elevated valuations, although there's some interesting arguments that because of the scalability of their businesses and the relatively stable revenue streams, although both Facebook last quarter and more recently Netflix both had 30% drops in their stock prices due to revenue reliability concerns, showing that the mega cap companies are certainly not immune to problems. Relatively higher valuations, whereas others are hovering closer to the median, both in terms of the 10-year numbers and some of the longer-term 25-year numbers. Volatility has had cooled a little bit after the COVID spike, but still it remained at slightly elevated, but more normal long-term levels, and of course has picked up more given the Ukraine-Russia conflict and other factors we've talked about. Consumer, corporate, and national debt is now, trends are maybe shifting a little bit in some cases. So with more savings waning after some of the depletion of the stimulus to households during the COVID period, the household debt ratio has gone up a little bit. You can see here some of the flow of savings that spiked much higher savings levels than normal, and that's coming actually back down to the longer term trend now that those stimulus checks are off and people have spent them to a greater degree. So some interesting numbers there, while the overall non-financial corporate debt market remains relatively elevated, but rates are, for big chunks of this segment of that market, rates, borrowing has been at a very low rate, so it makes it more sustainable, but we wouldn't be surprised if borrowing cools as rates are going up. So some valuable factors to keep in mind there. From a quality standpoint, if we look at high quality stocks versus low quality stocks, when we are building the portfolio structures, especially on the tax deferred side, we'll incorporate some managers that have a higher quality focus, and that can dampen volatility in certain markets. The higher quality, even though value did better for the quarter on an absolute basis, it did higher quality value did worse, whereas growth did worse on an absolute basis, but higher quality, excuse me, did better within growth, both for the quarter and the year. Just a quick snapshot for those that want to review again the capital market projections. Won't dwell on this here since we've already covered that, but as a reference, a quick view of the 5 steps of the process that we help clients through, both for personal wealth, foundation endowment, and retirement plans. And a note about investor behavior studies amongst institutional entities. There's a lot of talk of investor behavior challenges amongst the average individual, but it's also shown in studies that it's can be a detriment to performance in some institutional entities, foundations, endowments, retirement plans as well. So not entirely immune to those challenges. So having good guidance can reduce or eliminate that emotional investing effect. So I want to thank you for joining us today, and we will see if there are any questions in the question section. If you have something, we'll wait a minute or so here, see if something pops in. But thank you for joining, and if you don't have a question immediately here today, please feel free to reach out to us as things come up if you have a question now, and it's been a pleasure to be with you.